Let's just run through one of your big calls, that England has a bigger chance of winning the World Cup than Italy leaving the Eurozone. Walk me through the logic. I got Bet365 at about 20-1 for England to win the World Cup. I imagine Italy is somewhere way out there to leave the Eurozone.
It has to be, Jonathan. Yeah, morning, and thank you for having me on the show. I mean, I think the big thing about this is really that it's about the emotion involved in being a football supporter. Generally, a loyal football supporter has to suspend disbelief on a regular basis in order to actually turn up to a World Cup and keep watching it. We would advise that clients and investors don't do that with regards to Italian politics. Obviously, there are a lot of views out there with people saying that things are getting increasingly likely for Italy to exit the EU. The reality is that the constitutional barriers to Italy even asking their population the question that was asked to the British public are formidable. Don't forget that they'd have to change the constitution. They'd have to change Article 75 within the constitution, which basically means they'd have to have two parliamentary supermajorities and a plebiscite just to have the opportunity to ask the population whether they want to leave the euro or not. Now, if you look at the average life cycle of an Italian parliament since the Second World War, since the new constitution was enacted in 1947, it's about 12 months. So the chances of an Italian government even surviving long enough to be able to persist to ask the question are tiny, in our opinion.
So, William, just in terms of the emotional response, and you've sort of linked it to football on the eve of the World Cup, and I get it. The emotional response, though, is it tainting the valuation of the equity market? Are we still conditioned by a debt crisis that happened several years ago when it comes to shaping valuations of European equities? Does it still condition that valuation analysis?
Yeah, no, it's very true, Jonathan. I mean, these things can have an important impact. And our basic argument is to try and look through that, because I think the underlying fundamentals of the European stock market are looking up. Finally, as you know, Europe has long lagged the pickup in profitability that you've seen in the US. There's a number of reasons for that. Europe has endured this kind of rolling existential crisis that you alluded to at the beginning. But what you're starting to see is that because the economy has been operating pretty firmly, it's in a pause for breath at the moment, but that's nothing more than the jagged teeth of the business cycle, in our opinion. But the economy is finally providing cover for the corporate sector to improve profitability. So you're seeing profitability hook up, ROE hook up quite nicely across the board, including some of the banks as well. Now, that is part of the story that suggests that once you get through that tax boost you're getting in the US, you're going to see pretty nice earnings growth coming from the European corporate sector. So that's probably where you want to focus your energies to a certain extent.
So, William, but at the moment, though, it's the Buy America theme that seems to be taking over, and the valuation gap between the United States and Europe has existed for a long, long time. Is it a valuation gap or a valuation trap?
I think it is well, I mean, U.S. companies deserve to trade at a premium. They trend at a higher level of ROE. They are price setters rather than price takers. All the reasons why U.S. companies deserve to have a higher multiple. We don't need to run them through all now. But what we would say is that there should be a narrowing of that multiple, and you should see faster earnings growth over the period, over the next 2 to 3 years, once that tax hump is through in the U.S. corporate sector. And that suggests that at very least you want to have Europe, continental European equities on an equal footing within your developed market favourites.
So, William, you brought up the World Cup just to get people to read the research, and I imagine it worked on me, so I imagine it worked for so many other people. So I'm going to put you on the spot. Goldman are going for Brazil with their analysis, UBS using their analysis and coming up with Germany, ING on Spain. Where's Barclays? Where's William Hobbs?
Hope over experience has got to be England.